We're having a look at published accounts. We're going to look at the 2013 question. This would be a typical published accounts question. Bit of background first. Companies with limited liability must publish their accounts. This is because these kind of companies are companies where when they go bankrupt, the creditors mightn't always get the money that they're owed. So as a form of protection for our creditors, we're all meant to be able to read a copy of these companies' accounts by contacting the company's office. It's a form of limited protection for all of us dealing with companies with limited liability. This is according to the Companies Act 1986. Companies with limited liability must publish their accounts. Now what publishing their accounts means then is to send a copy of your final accounts and balance sheet to the company's office annually. Depending on the size of your company, the amount of the disclosure is greater. Small companies just send a copy of their balance sheet. Medium-sized companies, some of the final accounts and balance sheet. And large companies, those would be companies with high turnover and high asset values and more than 250 employees. Those kind of companies would have full disclosure. We'll talk about that later. You can check out what published accounts look like by going to the company's office website at www.cro.ie, and you can download at the moment copies of the final accounts and balance sheets for around €3.50, €4. So the challenge for the student is to more or less learn off the correct format of these final accounts, what they look like. And we're going to take, as I said, the 2013 year as an example. So let's look at what the final accounts will look like. This is very different now to the normal internal accounts. So let's have a look at the typical terminology. This is the abbreviated trading profit and loss account, and we start off with turnover. That's what you would normally call sales. But in published accounts, you've got to use that language, turnover, from which you'll subtract your cost of sales. Your typical cost of sales would be the things you're used in your trading account. Your opening stock, purchases, carriage in, maybe customs duties. If it's a manufacturing firm, you're going to find the cost of goods manufactured in your trading account as well, as part of your cost of sales. And in many leaving cert questions, you'll find patent write-off, the amortisation of patents, as one of your cost of sales at times. So you'll write down your turnover, from which you'll subtract a single figure for cost of sales, and that will give you your gross profit. Now in your normal profit and loss account, you've got lots of expenses. But from the point of view of published accounts, what you'll do is, you'll take all of your expenses, except interest. You'll take all of your expenses and you'll put them in under one or other of two headings. They'll either be called distribution costs or administration expenses. Now they might be the choice of accountants, that type of language or terminology. But according to the Companies Act, all of our expenses, other than interest, will go in under either distribution costs or administration expenses. And the way you approach it is, if it has to do with distribution, selling and distribution, if it is things like advertising or sales, salaries, or bad debts, or depreciation on delivery vans, showroom costs, expenses, those kind of things, they're all going under distribution. And if it has nothing to do with selling, it'll simply go in under administration. So you take these two expenses away from your gross profit, and then you add in what's called other operating income. Now in this particular question, the other operating income is made up of rental income, royalties received on patents, and there's also discount received. Now they're looked at as other operating income. Your main operating income is always turnover, your sales, usually. And what you've got to try to work out is, what have sales, rent and royalties got in common? What makes them operating income, whereas the likes of investment income and the profit on the sale of land or buildings won't be treated as operating income? And the main difference really is that your turnover, your sales and your income from rent and your income from royalties, this is income that's being generated internally within the firm from your regular day-to-day business. Whereas I think if you look at it, the income you earn from investments, that's being earned outside of the firm. And the profit you're making on selling a fixed asset, that type of capital income, isn't really looked on as your normal day-to-day sort of income that arises from your internal operations. It can be a bit confusing, but it's worth your while making an effort to distinguish between your operating income, which is your sales, your turnover, and your rent and your royalties, and very often in leaving such questions, discounts received, and other forms of income which aren't included in operating profit. So, having subtracted our distribution costs and our administration expenses from gross profit and having added in our other operating income, we get what they're calling operating profit. And then we add in our other ordinary income, like investment income in this question and the profit and sale of land. And then we subtract our interest payable. It's actually interest payable less interest receivable, but usually in leaving cert questions it's just debenture interest as we have in this case. And that leads us on then to profit and ordinary activities before taxation, from which we will subtract the taxation. The tax being deducted in here now would be your corporation tax. Remember, we're dealing with companies, so they're like corporation tax. We're not talking about VAT or PRSI or PAYE or any of the other taxes like universal social charge. No, none of that. It's simply the profit, the tax on the company's profits. One figure for that taken away from your profit to give you profit and ordinary activity after tax. And then a single figure for all the dividends paid. That gives you your retained earnings, your profit retained for the year, to which we add in the profit left over from last year to get our profits carried forward at the end of the year. So this is our typical final accounts set up. Next we'll have a look at our typical balance sheet. And again, this is very different to that which you may be used to for internal purposes. We'll see our balance sheet shows our fixed assets with intangible first, then tangible and then financial fixed assets. Intangible assets include things like patents and goodwill and trademarks. The tangible fixed assets would be the things like land and buildings and machinery and plant and equipment, the things that you can see and touch. And the financial assets would be, you know, your investments. One single figure for each of these is what you're looking for, which must be written in this order. We then go on to current assets. They comprise three items only: stock, debtors and bank. All of your current assets must be put into one or other of these three subheadings. Our stock would typically be our trading stock, whether it is finished goods or work in progress or raw materials. You could have stock of stationery and fuel in there also. Your debtors would be anyone who owes you money. Your typical trade debtors and any prepayments that you've made. And for example, like prepaid advertising or insurance, any prepayments. And amounts owed to us from things like investment income due would come in here as well, or any VAT refunds maybe. And then your bank would be your current account and your deposit account, and any cash that would be there also. That's your bank balance, money. The current liabilities are referred to as creditors falling due within a year. And they're only trade creditors, they're your suppliers. Your taxation, that would be any corporation tax or VAT or PRSI or PAYE contributions that need to be forwarded to the tax office, or USC charges. Any taxation due is in here, and then any other type of creditor will go in under that heading. These are your typical expenses due but unpaid. Anything that's not a trade creditor and anything that's not tax will be looked on as other creditors. Typically it would be things like debenture interest due and arrears in our expenses. We deduct our liabilities falling due within a year, or creditors here, from our current assets to get what is called in your published accounts net current assets. We normally say working capital here, but for published accounts it's net current assets. And we add that net current assets to our fixed assets to get what's called total assets less current liabilities. In our internal accounts we'd regularly call that our net assets, but here it's called total assets less current liabilities. And then we're on to the finance side of our balance sheet, where we start off with the long-term liabilities, but we call them creditors falling due after more than a year. And in companies typically it's debentures and bank loans. And then another subheading for capital and reserves. One figure for issued capital, then anything for capital reserves like revaluation reserve, and this is our revenue reserve, then our P&L balance that we carried forward here from our final accounts, the P&L carried forward figure there. And that's our typical balance sheet. In the Leaving Cert, as is with many exams, you'll find that you'll lose marks for incorrect sequence. These items must be shown in the correct order, and in that particular exam up to 5 points could be deducted for messing up the sequence, the order in which they must be presented. And of course sometimes items that will be put in under the wrong headings won't earn any marks. That will apply similarly down here in your balance sheet. Right, so our next job is to have a look at the figures for this solution.